Okay, good morning, everybody. I was hoping for more people to join, but I think it's 5 past 8 and we will start. Um, we have only 18 students. I'm not sure whether we should start. Anyway, it's okay. So I'll again put my video off and I have started screen sharing. So yeah, so we were looking at value at risk as a measure of risk. And we had defined yesterday value at risk to be statistical. I missed one word, measure of potential loss. So this is a statistical measure, and the worst loss we said will depend on two things. One is the confidence level and the other is the target horizon. So therefore, just to summarize, that the value at risk is the worst loss. I mean, this would be a formal kind of a definition. Worst loss over a target horizon. It could be worst loss in a day. It could be worst loss in a year. Such that this is the worst loss, such that there is a low, uh, low but pre-specified probability that actual loss, the actual loss will be higher than this, higher than whatever were be higher. So mathematically or in statistical parlance, what we are saying is we will have the probability that loss is greater than value at risk is should be 1 minus C, where C is the confidence level. So 1 minus C is the probability that the actual loss will be higher. So if we are looking at only losses. Now, typically whenever we have loss, we have two things, two parts. The loss depends on the current exposure to the risk factor that we have. If we are holding dollars, then how much dollars we are holding. If we are holding equity, then what is the market cap of that equity that we are holding, and so on and so forth. The current exposure to that risk factor and volatility of the underlying factor. Now, a lot out of this, the volatility of the underlying factor is not really in the hands of the investor. Whenever we invest something, we invest looking at the volatility, but once we have invested it, the volatility of this underlying returns or whatever, or the exchange rate, that volatility is not in our hands. What is in our hands is the current exposure. However, volatility does look at the risk. So to have some control, we typically will have measure loss in terms of some current exposure and the volatility. So this is something that we can control. This is not what we can control. So just to give some examples therefore, but before that we will give the steps, or maybe we will do some examples, basic simple, very simple examples. First, let us take the discrete case of losses like we were doing yesterday. So suppose we have some kind of a project or some kind of an investment where we have only three possibilities. That is, there is a so there are only three possibilities, that if we take up this project, there is 98% chance of having a gain of say 10 crores, or say a 1.5% probability of having a loss of 2 crores, and a 0.5% probability of having a loss of say 5 crores. So this is a discrete case. So if we measure gains here and we mark these three values, so again, so we have 0 value here, a gain of 10 crores, a loss of 2 crores and a loss of 5 crores. So this is minus 2 and this is minus 5. So if we were to draw these probabilities, this is just one probability of 0.5. This is another probability of maybe 1.5. And then this is 98.5% probability. Okay, at 10 crores. So we have this a discrete thing. Now if we ask what is the 99% value at risk for this project, till now we don't have a horizon. Only thing we are assuming the gain, whatever the gain is on the horizon only. So if it's a if we are looking at a 1 day where these are 1 day gains, if we are looking at a 1 year where this is a 1 year gain, whatever. So the horizon is kind of captured in the gains itself. That is the gains over that much horizon. And so if I want 99% this thing, so now if this we said is 0.5% probability, this is 1.5% probability, so this is 2% and this is 98% probability alone, which means the expected loss or expected gain. What is the expected gain then? Somebody please quickly do it and let me know. Expected gain. Yes, please. I want some people to answer. So let me ask. Arnesh, are you there? Arnesh?
Yes, ma'am.
Okay, so now
I'm just calculating that.
good. Calculate and let me know. So
Ma'am,
calculate aloud.
9.25 CR.
9.25 is the expected gain. So
Yes,
somewhere
ma'am.
here, 9.25 is the expected gain. Okay. So this is 9.25 is the expected gain. But there is a possibility of loss also, and we want to know what is the 99% value at risk. How do we do that? So kind of a you mentally do a cumulative probability. So if I am at 5%, 5 crore gain, then actually I have reached only 0.5%. Now if I have 99% value at risk, I want to find out that loss such that the area to the right is 99.99%, right?
Yes, ma'am.
So we want a loss figure such that the probability that loss will be even greater, that is a probability of going even below. So this is again, this can be anything. So probability of the loss of going even, we have to find a specific loss such that the probability of going even below is only 1%. And there is 99% probability that the gains will be above that value. So we have to find a value such that, so if I write this as var, let me write this as var. So if I have to find some value here on this axis such that the probability of the gain falling below the var, that is the losses greater than var, will be only 1%, and rather the gains will all remain above in the 99% range. So now you see there is only 0.5% probability of this loss of 5 crores, whereas there is, so on a cumulative basis, if we were to draw this on a cumulative basis, this is 0.5, then we go here and we go up till 2%, right? And then we go here and then this becomes 100%, right? I think I made this. So then this becomes 100%. Okay, so this is the cumulative kind of a thing. So this was 0.5, this is 2%. That means if I want one value of one value such that I have 99%, then it is here. Between 0.5 to 2%, I want 1%. So 0.5 to 2, I am somewhere here. So my value at risk, therefore, is a loss of 2 crores. So my value at risk, the amount I can lose on this project is kind of 2 crores. Is this method understood?
Yes, ma'am.
Great. So now let me give another problem and somebody will solve this. Another discrete case. Say
Hello,
yes, please.
ma'am. In the last one, um,
Ma'am, expected one is wrong. It's 9.745. I took mistakenly 15%
Okay.
instead of
The
1%.
expected one does not matter very much, but we will tell you why the expected one also is important. So what is this value?
9.745.
Okay, thanks. So this is 9.745. Now this is the worst loss that can happen. Okay, so what we gave is the worst loss that can happen. Now whenever we talk of loss is always with respect to what? Okay, is it just the rupee loss? If it's just the rupee loss, then the value at risk is 2 crores. But if you were expecting 9.745, but there is a loss of 2 crores, then we would say that the relative value at risk on a real, so this is what we will call absolute value at risk. Okay, this is actually how much? I mean, this is with respect to 0. However, if I want to know what is there is something called the relative value at risk. Relative value at risk finds losses with respect to the absolute thing. So if my expected gain is 9.745, but I make a loss of 2 crores, that means my value at risk relative to the expected gain is actually the expected value plus, I mean, basically this much distance. The expected value plus this. That is the loss. All right. So on a relative term, we will say that with respect to the expected value, the value at risk is actually 11.745 crores. So we have an absolute and relative. Is this kind of understood?
ma'am, hello,
Yes, please.
ma'am. For 2 crores VAR, isn't the confidence?
Yeah, carry on.
But we want the VAR for 99% confidence level.
Yes, we are for 99%. So here, if I take 5 crores, it will be only 90, it will become 99.5 percent confidence level, because 5 crore
Yes,
will not be exceeded 99.5% of the time.
yes.
Now, if what I understand what you mean, you are saying that you will make an assumption that this is uniformly distributed. Okay, so let me say what's your name?
Aditya.
Sorry,
Aditya.
Aditya. Okay, so that's a good question. So when I draw this cumulative distribution like this, then my 99% lies somewhere here only. Okay, that is at 2 crores the probability is 99.5 as well as 98, so somewhere in between. So because it is 99 lies here, so I am taking, so if I call it in a probabilistic term, if this were to be a probabilistic probability figure, and I want 99% somewhere here, sorry, 1% is somewhere here, 99% is somewhere there. So 1% would basically cut it at this point, and I go down and see what is the gain or loss figure at this point. Okay, so this is my 1% below and 99% above. Fine.
Yes.
But yours is a good question in the sense that I assumed that there is no change in probability between 5 crores and 2 crores. What you are alluding to is that I draw this as a like this. So my 99 will kind of intersect at this point, and so you come down and read this as your value at risk. Is that what you're alluding to, Aditya?
That is not what I was saying, but
Okay,
I've
then I
understood it.
go back. Yes, then what were you saying?
I understood it now, that the 1% also comes at 2 crores.
Yes,
I got it.
1% also comes at 2 crores. So this is, if we say it like that, we will say it's uniformly distributed. I'll come to such an example a little later. But when I have only discrete three values, then we find out at no, I want 99% above, 1% below. So at 1%, where do I reach? Do I reach at 5, or do I reach at 2, or do I reach here? Obviously, I will have to reach here. So this, then I go down, and that is my value at risk. Is that fine?
Yes, ma'am.
Okay.
Yes, ma'am.
Yeah, and there is this concept of absolute value at risk, which is just with respect to zero, so just the loss. And there is also something called the relative value at risk. That is, I was expecting 9.745 crores, but I have made a loss of 2 crores. I can make a loss of 2 crores. I had not have. I can make a loss of 2 crores with a confidence level of 99%. That's the worst I can have. So the worst loss is, when I say relative, I'm saying it is with respect to what I was expecting. Okay, so with respect to the expected value, when I calculate value at risk, then I will call it a relative var. Otherwise, it's called an absolute var. Is that understood?
Yes, ma'am.
Okay, so now let me give another discrete case and let me ask somebody. So then this is from the book only, but anyway, so suppose you have gains with some probability. Now, okay, so let me just give some numbers. -3 has a probability of 0.01, -2 has a probability of 0.03, -1 has a probability of 0.02. Then a gain of 1 has a probability of say 0.4, a gain of 2 probably has a something like that, and we can go on. I'm not writing all of it because all of it will give you the value of expected gain. I don't want that. Let us look at only the absolute var, and then the expected gain is easy. You just have to find the expected values from this kind of a table and then add the var. So we will not look at the relative var from this example. Just give me the absolute value at risk, say at 95%. So let me have the 95% value at risk from this data. All right, and so I'll again ask somebody else, maybe Abhinav. Okay, all the A's otherwise. Okay, Tushar, are you there? Tushar, Tushar, are you there? Okay, so Tushar is, no, my daughter also puts the video on and then goes back to sleep. Just now I scolded her and came here. Okay, so Tushar is probably absent or sleeping, or maybe he has actually dropped off. We do not know. Let me call whom? So Vaibhav, are you there?
Yes, ma'am. Ma'am, it is
Great.
1 crore.
1 crore. Very good. So 1 crore, why? Because you have to reach 95%, that is 5% from below, right?
Yes, ma'am.
So 4 and 1, you are here at 1. So absolute value at risk would be 1 crore. And if I wanted the relative value at risk, you would have to find the expected gain from all this table and then add that value at risk to it and then give the relative value at risk. Is this understood? So the discrete case is clear?
Yes, ma'am.
All right. Now let us look at the continuous case. And continuous case, now let me give again a very simple example. Suppose you have a project in which there you can have a gains of, so first we'll keep it simple, 70 and any value between 70 to -30 equally likely. That is a uniform distribution. So gains are uniformly distributed between a loss of 30 to a gain of 70. All right. So I have my 0 somewhere here. This is my 0 value. So gains are distributed uniformly. And here I'm saying this is a uniform distribution. And anything, say I want 95% value at risk. So somebody again will tell me. So first of all, because it is uniform distribution, so we will have it like this. So what is the value of this probability of any value? This probability, what is the height? If this is the area under this is to be 100%.
1% each.
This is 1%. 1%. Let me write it. How do you get? If this is A and this is B, then this is 1 by B minus A, right?
Yes, ma'am.
This height. Now I want that value. Now I want that value such that the area to the right is 95% or the area to the left is 5%. Now, because it is continuous case, now my cumulative will be area under this PDF. So we are looking at the cumulative distribution function actually with 5%. But okay, the area under the PDF has to be 5%. And so if the height is 1% and I want 0.05 area, then can you tell me what is this value at risk?
25, minus 25.
Minus 25, correct. Everybody understands? Any doubt? Actually not. So because var is a loss measure, we will not put minus 25. This value is minus 25, but when we will report it, we will call it just 25. Okay. So we will not report it as, so we will just call it 25 crores. If all of these are in crores, then value at risk is also 25 crores. But this, remember, is the absolute value at risk. Okay. This is the absolute value at risk. What is the relative value at risk? So let me ask somebody else. 1 minute. Whom should I ask? This is, okay, I keep forgetting. Saurav, you're Saurav or Girish? I forgot.
Ma'am, this is Saurav.
Saurav, no? Okay,
Yes.
so Saurav, can you tell me what is the relative value at risk? So you will need the
Yes, I'm calculating expected value.
expected value, yes.
Ma'am, it's 0.89.
0.89. How do you get 0.89?
Minus 3 into 0.01 minus 2 into yes, 0.06 minus 0.02.
1 minute. What are you writing?
Minus 3 into 0.01 plus minus 2 into 0.03.
1 minute. Minus 3.
Yes.
Minus 3 into 0.01.
Minus 2 into 0.03. Minus 1 into.
Where are you going? Here, you're going here.
Yes.
No. Don't get into that. That I have not even given you the full distribution. This does not add up to 1. I'm asking in this case, the continuous case, the uniform distribution case.
Okay. That will be just 20.
Yes, correct. That the expected value is 20.
Yes. So the the relative will be 20 plus 25.
So relative value at risk will be 45 crores. All right, because 20 is what you were expecting, but the worst loss can be 25 crores, and hence you are looking at it with respect to the mean. What is the expected loss? Okay,
Yes.
so this is the continuous case. Now, just to go more in, now we will have even more, say, normal distribution. So when we look at normal distributions, I don't know if you have it. Anyway, let me take it out, normal distribution from somewhere. So, you know, there are certain steps when we will do normal distribution. So before we get into steps, let us say, so if I have gains, sorry, if I have gains which are normally distributed with some mean, say 25 crores and a standard deviation or a variance of say 900 crores. This is how my gains are distributed. All right. So if I have gains, I have somewhere 0 here, and on an average it is 25. I'm pretty bad at drawing. So this is 25. So this is, please assume this is the peak, huh? I don't, anyway, this is the peak of the normal distribution. So this is 25 mean, and this is normally distributed with variance of 30, right? Now, if you have to give me, say, 99.9% value at risk, 99.9% value at risk, what would you do? Yeah, any idea?
Ma'am,
You go 3 times the standard deviation.
Yes. Sorry?
3 times the standard deviation to the left.
Yes, very good. So I need a value such that this area to the right is 99.9% and this area to the left is 0.1%. Okay. Now what you can do is you can look up a Z table. So let me see whether I can get standard normal table. Let me try to make this bigger if I can. Acha, can you read this table? Have you learned how to read this table? Yeah, have. All right, let me then ask somebody because nobody will tell me directly. All right, so let me ask someone. Tejasvi, are you there?
Yes, ma'am, I'm there.
All right. So now I want 99.9%. So how do you read this table? This is the standard normal curve. How do you read this table? Are you? Do you have any idea?
No, ma'am.
Okay. Have you studied this?
Yes, ma'am.
Okay. All right. No problem. If you don't do this regularly, you can forget. No problem. But please don't forget it from now on. All right. So let's see the example that is always given with such a curve. Huh? So it says that if I am at z is equal to 1.45, this area is 0.4265. That is, if I am at 1.45, you see this area is 0.4265. Is this, can you see this? Is this visible?
Yes, ma'am.
Okay, the more I make it bigger, it's becoming less and less sharp. So, okay, so at 1.45, when z is equal to 1.45, 1.45, the area is 4.4265. Fine. So this area is 0.4265. And because this is symmetric, this area is 0.5. All right. So totally it becomes 0.9265. Now you want a Z such that this total area should be 0.999. Tejasvi, am I making sense?
Yes, ma'am.
So 0.999 means 0.5 will go here, and you want therefore 0.499
Yes, ma'am.
on this side. So what do I have to do? I have to look inside the table for 0.499 and then go backward to get the corresponding Z value.
Understood, ma'am.
Great. So then, so 0.499, and where do I have 0.499? I have it somewhere here, exactly. So it is 3.0 something. This is 0.499. So we can call it 3.1 almost, because this is also 3.1. Everything is 0.499. So we will call this as 3.1. Okay. So at Z is equal to 3.1, Z is equal to 3.1, the area to the left of the curve is 0.999. Because this is symmetric, so area to this also, if I take it minus 3.1, then the area to the right will also be 0.999.
Yes, ma'am.
Fine. Okay, so I'm assuming everybody has understood. So this value, therefore, we will mark it as minus. So remember, that was the Z value. Okay, so Z value, if I have the Z value, so Z value is minus 3.1. How do you get the value, this value then? This value is given as mu.
Into Z into mu plus mean.
Yes. Basically, this value will be, any value on this will be given as mu plus Z sigma. Any value on this. So my mu is 25. So 1 minute. So my mu is 25. Z is negative and sigma is 30. Is the calculation clear?
Yes, ma'am.
Yes, ma'am.
All right. So what is this? Minus 90 is 90.1. So this will be what? 65, right? This value is minus 65.1.
It should be minus 68.
Okay. This is 90.3.
Yes, ma'am.
This is 90.3 and 25. So sorry. Then it will be
Ma'am, it's minus 68. Just that.
this
Because
value
it's,
would be
Ma'am, it's 93, not 90.3.
yes, ma'am.
oh,
3.1 into
okay, 90. Not 9. Okay, 93, not 91. Sorry. Okay, sorry, my mistake. And here also minus 68.
Yes, ma'am.
93. So this is minus 68. This value is minus 68. Okay. So again, therefore, you see, what is my value at risk is 68. If we are looking at it in terms of crores, say, whatever. So my value at risk is 68. All right. My value at risk is 68. And with respect to the mean, therefore, again, it is this much is only Z sigma. So it will be exactly 93. So my absolute value at risk is 68 and my relative value at risk is this entire thing, so it will be 93.
Yes, ma'am.
Understood?
Yes, ma'am.
All right. So when it comes to therefore a normal distribution, what we get is something like this. All right, let me do it in terms of what we will do really. Rather than taking gains in finance, we will look at returns. All right, so we will look at returns. Therefore, so what we do in with real data, and now we will download some real data. We will first mark to market our current exposure. We will call this the W0. Then we will, these are the steps how we will calculate the value at risk, assuming distribution like normal distribution, say. Then we will set the time horizon over which we need the VAR. Say we take 1 day VAR. We want to know what is the worst loss, what can be the worst loss over 1 day. Then we will get then we will get sigma of the, basically we will download the data and we will get sigma of the underlying risk factor. In this case, we will say that returns are the risk factor. Okay, so this exposure is W0, and if we are investing in equities, then the returns will be the risk factor, which is a random variable. Returns is the random variable, and we will then once we have, so we can estimate the sigma. Then what we will do is we will set the confidence level. All right, before that, sorry, let us, we will assume a distribution of that risk factor. And here we are assuming that it follows a normal distribution. That's an assumption, but and finally we will, not finally, we will set a confidence level, and finally we will, I mean, then after that we will exactly get this Z and all to get the report the worst loss or estimate the worst loss. Okay, so these are the steps. Now, if I take some data, and again we will do it. All right, first let us take some data. We will stop this. We should have kept this anyway. So I've gone to Bombay Stock Exchange. Have you ever downloaded data? I'm assuming you have downloaded data before. So this is Bombay Stock Exchange. Yes?
Yes, ma'am.
Oh, yeah. So you must have done projects and also you would have known this. So I've gone to Bombay Stock Exchange. Nowadays, NSE has only gives paid, all its data is paid. Only still now Bombay Stock Exchange gives data free. So we will go to historical data. And once we get into the historical data, so we are taking equity, but if you want later some index, you can go to index. If you want to go for derivatives, currencies, everything, they are all there, but right now we will stick to equity. And within that, you can see there is something called historical stock prices. So we will then have to give the name of the security. So let me see with my name, what am I getting? Parama, try to take, I don't know, many of these may not be very, liquid. So I think Punjab Alkalis and Chemicals Limited would be a good company. I'll take daily data because I want daily value at risk. So suppose I want from January 2019, 1st January till 1st January 2022. Okay, and I submit, and this is my Punjab Alkalis Limited. All right. So these are the share prices. Approximately in 2019, it was around 45 rupees. So then I will download this. So if I click, I think below also there is somewhere here. So I can click, and this is the CSV file that I will get. Okay. I hope you can see this file. And
Yes,
so
yes.
we will not work on open, high, low price. Rather, we will maybe I'll delete it all. We will work on the close price. And I hope you understand this is weighted average price. This is number of shares traded in through how many trades. So 804 trades, but number of shares traded was this. So total turnover would be these two deliverables and all this. I don't want to get into this data. So we have closing prices. Okay, now we can do two things. One is we can get the gains, or we will get the returns. So typically in finance we will get the returns. Okay, therefore the returns are these have gone the other way around. So this is 31st December 21, 30th December 21. So returns are defined as, you can define arithmetic returns as P1 minus P0 divided by P0, correct?
Yes, ma'am.
Yes, ma'am.
Or you can estimate it as logarithmic returns, which is ln of P1 divided by P0. Fine?
Yes.
The reason I'm doing it is to explain that, all these things we do are so much dependent on these methods. So, all right, first let us do this. So these are the arithmetic returns. If I take arithmetic returns, I'll get something. If I take geometric returns, I'll get something else, right? So what we will do is, we will take these returns and put them as values somewhere. So these are arithmetic returns, and we can also take the logarithmic returns. So these are the logarithmic returns. Okay, now forget the logarithmic returns for the time being. We'll work on the arithmetic returns first. So we can get a mean value. Mean value is equal to average. You can do this in Python as well, but let us keep it like this. So this is the mean, and you can also get the standard deviation. We can get the standard deviation. All right. Here you go. So this is the standard deviation. Right. Now, if you think this is the mean return and this is the standard deviation of the returns, I'll just take it back. Do remember the numbers and give the numbers to me. So these are average daily returns, and this is the standard deviation of daily returns. All right. So average daily returns and standard deviation of daily returns. So give me these numbers once I. Okay. So let's go to. So if we assume that returns follow a normal distribution with mean was how much? 0.004, I guess, na? I forgot. Somebody noted down the numbers.
0.003.
003 with a standard deviation of 0.03, na? I forgot. Told you to.
0.04.
This was 0.04.
Standard deviation.
Yes, standard deviation is 0.04. This is standard deviation. If we assume returns, this is a big assumption, okay? And you can make a do you know how to test for normality, whether the data follows normal distribution or not? Okay, just as an aside, there is something called a Jark-Bera test of normality. Okay, typically it is assumed that the normal distribution has a skewness of 0 and a kurtosis of 3. Okay, the normal distribution. So you can check for the skewness and the kurtosis, but the Jar-Cabrera test, basically the JB statistic is given as skewness square divided by 6 plus kurtosis minus 3 whole square divided by 24. So you have to, so you know probably the skewness is the third moment. So the skewness is defined as 1 by n minus 1 summation of xi minus x bar whole cube divided by sigma cube, where sigma is that standard deviation. And kurtosis is basically 1 by n minus 1 summation of xi minus x bar whole to the power of 4 divided by sigma to the power of 4. You know these things, I hope.
Yes, ma'am.
Yes, ma'am.
So yeah, so skewness for a normal distribution is assumed to be 0, so it's just taken as skewness square, and kurtosis for a normal distribution is assumed to be 3, so it is taken as kurtosis minus 3 whole square divided by 24 and into the number of data points. So if you have t data points in this case, whatever data point number of data points you have, that is your JB statistic, and it kind of said to follow a chi-square distribution with 2 degrees of freedom. Okay, you have used up a x bar and a sigma in order to calculate the skewness and kurtosis. So 2 degrees of freedom you lose. You lose 2 degrees of freedom because of that. And then you can see, you know hypothesis testing, how to do?
Yes,
Okay.
ma'am.
Yeah, so if using whatever data you have, suppose that past data what we downloaded, you can calculate the skewness, you can calculate the kurtosis. So from there you will get a JB calculated. And suppose you want 95% chi-square with 2 degrees of freedom, you have to look up the chi-square statistic and get the chi-square critical value. So if JB calculated is greater than chi-square critical, you will say the data is not normal. If JB is greater than n, that means not normal. And if it is less, then you will say, okay, the data can be told to be normally distributed. Financial data typically will never be normally distributed. They have skewness is more or less 0 most of the time, but kurtosis is never equal to 3. It's you typically have fat tails, and so here it fails basically. So anyway, so here we are making that assumption that it follows a normal distribution, and this I'm talking only in terms of returns. Returns typically have fat tails but 0 skewness. So they are typically not normally distributed, but we are assuming that here. Now once we assume this, therefore and that is where we were saying you mark to market your current exposure, and now we have set a 1 day horizon, that is we want say a 95% or whatever 95 or 99% 1 day value at risk. That is what is the worst loss with over a day that can happen to this stock. Now the moment I say mark to market, so suppose I have said I have 1,000 shares of this company, whatever company I took. Okay, so this company was Punjab Alkalis and Chemicals Limited. So the moment I say I have 1,000 shares, that means today's okay, so it didn't give me today's there's no share price. It's not very liquid, apparently. So we will take 291.95 paisa. 291 rupees 95 paisa is the 100 shares of Punjab Chemicals and Alkalis Limited at 291.95 rupees, which means my my asset size is basically 2919.5 rupees. Correct? No, much more. Sorry. What am I doing today? Okay. So I have 291,950 rupees, right? 2,91,950 rupees is my portfolio, rather my asset size. Now I want to know in this asset size, what is the worst I can lose over a day, and which I can say with say 95% confidence level. So this is my alpha, my horizon is 1 day. Over a day, how much, what is the worst loss that I can have over this asset that I'm owning? All right. So then what did we say we need to do? We have to get the sigma. We have already got the sigma and we have to find. So what did we say? We have now got a, now we have returns, not really gains. Return is nothing but a gain figure, but in percentage terms. What is the benefit? Why do we in finance, why do we take returns? See, you see, this was kind of a loss of about say nearly 10 rupees on a, no, how much is this? This is about 9.89. Nearly 9 rupees over 290, over a 300 rupees asset. So you have 9 rupees loss over a 300 rupees asset. Whereas you can also have a 9 rupee loss over a 1000 rupee asset and a 9 rupee loss over a 100 rupee asset. So these three losses are really not comparable. A loss of 9 rupees over a 1000 rupee asset or loss of 9 rupees on a 300 rupee asset and a loss of 9 rupees on a 100 rupee asset. They are not comparable and hence the returns are basically the loss over the the size of this size that is there. So returns are more comparable across assets and across securities. So that is why in finance we will always work with returns. But okay, so we will have returns hence. But now again, so we have assumed that the returns follow a normal distribution with this mean and this standard deviation. We will need the 95%. So first of all, we will have to find out a R star. So we will need an R star such that the area to the right is 95% and area to the left is 5%. Okay, so we will need an R star such that the area to the left is 5%. There is this expected value. So we also have, remember, we have something which is a zero value. The zero is somewhere here. This is the zero, but this is the expected value. So expected value is 0.003. Standard deviation is this. So what will my R star be? Can somebody tell me?
Ma'am, minus 0.0628.
Okay, let me ask someone. This is Sigangsa. Sigangsa, are you there? Did I? Okay, Sigangsa. Sigangsa, are you there?
Yes, ma'am, I'm here.
Am I pronouncing your name correct?
Yes, ma'am.
And what's the meaning of this name?
Forward. Forward, ma'am.
Oh, sword. That's dangerous. Okay. Sigangsa, therefore, all right. So can you then tell me what is my R star such that I have 5% to area to the right and 95% of the time returns will be greater than this R star. So what will we do typically? We will go to the Z table, right? We will go to the, can you see this Z table here or I'll make it bigger?
No, ma'am, it's not visible.
It's not visible?
No, ma'am.
Okay, so let's go here. Yes. All right. So now I want 5% and 95%. What is my value?
Ma'am, it's 1.645.
Sigangsa, are you responding?
No, ma'am, that wasn't me.
Yeah, so I want Sigangsa to respond, please. So Sigang sir, let's go one by one. I want 95%. How do I get 95% from here? 95% would be 50% on the left and 45% on the right?
Ma'am, I forgot. I wasn't.
All right. So once again, if you look at this table, this example, at z is equal to 1.45, z is equal to 1.45, you have 0.4265. Sigang sir, are you listening?
Yes, ma'am, I'm listening, ma'am.
Okay, so this is 0.4265 is the area to the right till the z value. So if it's 1.45 from 0 till 1.45, the area under the curve is 0.4265. This is 0.4265. Now I want it the opposite. I want a z such that this entire area is 95%. This 0.95, this area is 0.5 because this is 1, this total has to add up to 1. So this side is 0.5, this side is 0.5. I want a z such that area to the left is 0.95. Okay, so if I want area to the left is 0.95, this is 0.5. So this I want an z such that the area below this would be Sigang sir, the area in
0.45.
0.45. So I have to look inside the table, find where 0.45 exists, then go back and see what is the corresponding z. Okay. Now can you tell me where can I see 0.45? For what value of z can I get 0.45 area?
1.64, I think. 1.64 or 1.65.
64, yeah, between, so let us call it 1.65 or what if 1.645. So is it clear now?
Yes, ma'am.
Okay, so my z value therefore is 1.645. So what is this r star therefore? If this follows a normal distribution with this mu and sigma and z value is 1.645, so what is my r star therefore? This is equal to mu plus z
0.0688.
0.003. See, this was in the left, that was in the right, so it was plus. If I bring it in the left, because normal distribution is symmetric, so we will have minus 1.645 into 0.04, right?
Yes,
Is this,
ma'am.
and what is
Yes,
the
ma'am.
value?
Ma'am, minus 0.0628.
Again, this is not Sigangsa responding.
Okay, ma'am.
Who is this? I won't scold you, just tell me your name.
Ma'am, I thought the question was general.
Okay, no problem. Don't get frightened. I'm just asking who are you? I can't see you. See, I find it very odd. That's why I hate this online class. Otherwise, in 3-4 classes, I would know each one of you. Can you tell me your name? I have no problems. I'm happy you're calculating upfront. What's your name? I can't see you. Come on. What's your name? Arey? I won't eat you, bhai. I won't even give you bad marks. I won't do anything. Please tell me your name. Karthik, was that you?
Yes, ma'am, that was me.
Okay.
Actually, I
Okay.
thought you were
No
talking to
problem.
Ellie.
Whatever you thought, you answered. I'm happy. Sigang sir, are you clear?
Yes, ma'am.
Okay. So we'll come back. So this is my R star. And Sigang sir, what is this R star? So this is my R star. This tells me that this is the worst return that I can get. Okay, the worst return. It's not the worst loss yet. But I want the value at risk is the worst loss. How do I get worst loss? Is the worst return that I got. So if I know that, all right, going back to, first standard of finance class, that is your initial first day of class. Suppose I keep 100 rupees in the bank. Okay, and my return is 6% over any one period. What is the what will be the value then?
106.
106. How do you get it? Isn't it?
Yes,
Yes,
ma'am.
ma'am.
So from a return figure to get the value will be value, current value into 1 plus r, isn't it?
Yes, ma'am.
Yes, clear now?
Yes, ma'am.
Yeah, I'll remove this because this we should not be talking about. So if you find that your worst loss today, you're holding this much. If your worst return is this, so how much will be your worst loss? If this is your return, 1 day return, in a day the worst value, not worst loss, sorry, the worst value can be, let me write it, w star.
The initial value into the returns.
Yes, w star will be equal to initial value into 1 plus r star.
Yes, ma'am.
Correct? So the worst loss, therefore, will be equal to whatever I'm holding today minus the worst condition of the portfolio.
Yes, ma'am.
And this will be equal to, because this is W star, so we will have W0 into R star.
Yes, ma'am.
Correct?
Yes, ma'am.
So now can you tell me, Sigangsa again, can you tell me what will be the worst loss in this case if I today am holding a asset of worth 2,91,950, and in 1 day the worst return can be minus 0.063. What will be the loss that I can have? Quickly, can you calculate and tell me?
Just a minute, ma'am. I don't have calculator with me.
Please sit with your calculators, from now on. Yeah, quickly.
And is it 183? 291,982.
I don't know. I am not doing it. You are doing it.
Okay.
So there will be a negative, W0 minus W star will be W0 minus W0 minus W0 into R star. Because R star is itself negative, so this will be, what is the value?
Minus 18392.
18392.
Yes. Minus negative.
No, 1 minute. This is negative, this is also negative, so this becomes a positive value.
Yes.
Correct? Because this W star was nothing but W into 1 plus R star. So W0 minus W star would be minus W0 into R star. So this would be, R star is negative. So negative will go out and become a positive value. So the worst loss amount is 18,392. Everybody agrees?
Yes, ma'am.
Okay, 18,392. So if I'm holding a asset worth 2,91,950, the worst I can lose in a day is 18,392. Is this understood? Is this understood?
Yes, ma'am.
Or not understood?
Ma'am, understood.
Okay. So this again remember was my absolute loss. Okay, this worst loss is the absolute loss that I can have, but I also have something like an expected loss, expected value. So this is this, when we do it like this, we are actually saying today I'm holding this, tomorrow this is like tomorrow's loss. Okay, so there is also an expected value of my asset tomorrow, which will be given as W0 into 1 plus R bar. R bar is this value.
Yes, ma'am.
Today, if I am holding this, that means tomorrow I would be expecting W0 into 1 plus R bar.
Yes, ma'am. Ma'am.
Okay, and then the worst loss. So this we will call this the absolute value at risk. If we were to find the relative value at risk, we said we will find that relative value at risk with respect to what we expect. Isn't it?
Yes, ma'am. The relative we are.
So if we wanted to find the relative value at risk, relative, the worst loss in a relative sense, that would be equal to W0 into 1 plus R bar, which I was expecting, minus the worst loss W star, which is basically W0 into 1 plus R star. So in a relative sense, this is equal to W0 into R bar minus R star. Do you agree?
Yes, ma'am.
Okay. And R star we wrote as R bar plus Z star into sigma. So we have W0 into R bar minus R star is basically minus Z star into sigma. That is, we have minus W0 Z star into sigma.
Yes, ma'am.
So then we have two estimates. Then if the worst loss absolute was equal to W0 into R star, which can also be written as W0 into R bar plus Z star into sigma. This is the absolute worst loss, and this is the relative worst loss with respect to the mean, what I am expecting tomorrow. Okay, now we are in a position to say which one do you think is a better measure. We should we look at the absolute worst loss or the relative worst loss? So whom should I ask? Motiar, can you try to answer this? Motiar, are you there?
Yes, ma'am. I think it should be absolute.
Why do you think it should be absolute? Why? You may not be correct, but still you had thought it should be absolute. Why? So when we said absolute, we basically said W0, what we are holding today, minus W0 into 1 plus R star. That is how we got this. So this is what we are holding today. Mark to market asset today. And this part is the worst asset value tomorrow. And this is basically tomorrow's now. Motiyar, can you explain?
Yes, ma'am.
Tell me.
I think maybe because the absolute value would be greater than the relative, so it would be more safer. Like if we,
Absolute value will be greater than relative. Absolute value is this much from 0 to R star.
okay, sorry, the opposite, ma'am.
Sorry, the absolute value will be this much from 0
Yeah,
to R star.
yes, ma'am. The
And
relative will
relative
be
value would be this much from the mean till the R star.
yes, ma'am. So the great we'll take the greater value.
Yes. So 1 is the greater value. Anybody can suggest any other reason? I mean, why are you saying greater value? Because why do you want to take the greater value?
Ma'am, I had a
Just to
doubt
be
here.
1 minute. Yeah, Motiyar, just to be.
just to be safe. If we can survive the worst possible condition, then we are good to go, right?
Yeah, so if we were expecting something and how much, but instead we have made a loss, we would like to know, i- i- how much have we actually lost with respect to our expectation? This tells us how much we have actually lost with respect to our expectation. This is just the loss.
Yes, ma'am.
Okay. Yeah, somebody else had a question.
Yeah, yes, ma'am. Ma'am, like if we like that would be the case if we are like, for example, if we are to invest in something using this money, like if we are expecting some returns and we are planning on investing that, but if we are just keeping it as an investment point of view, shouldn't the absolute value be all right? Like that's like absolute value is the value that might go out of our pockets, right? Essentially.
You think of it this way. Today you're holding 100 rupees.
Yes.
You hope to hold 106 rupees tomorrow.
Yes.
Okay. So let us make it a timeline. So this is today.
Yes.
Tomorrow, today you're holding 100 rupees.
Yes.
Tomorrow, and this loss won't happen right now. This loss, the moment we have made it into 1 plus R star and all that, will happen tomorrow. Tomorrow, the
Yes.
loss will be, this value will become maybe say 98. So you have lost something like, you can lose 2 rupees. But is it
Yes.
98 is 2 rupees? Because tomorrow actually you were hoping that this would go up to 106.
Okay.
So you have kind of lost 8 rupees, isn't it?
Yes, ma'am. Like, ma'am, that only I was just asking. Like, that depends on our purpose, right? Like, if we are just planning to hold on to 100 rupees, like say, like we wanted to. Okay, ma'am, I got it. Like, we'll still be
No, we
having a
will never,
profit.
we hold the asset. And whenever we hold the asset, we want the asset to grow. That's why we are
Okay,
investing.
ma'am.
Na?
Yes, sir. Yes, ma'am. Yes, ma'am.
So whenever we want to, so the moment we make it W0 into 1 plus R star, we are kind of going tomorrow.
Yes, ma'am.
So we should compare it with what we expect it to be tomorrow.
Okay, ma'am. I got
And
it.
then see what is the total loss that might happen. So my worst loss is not really 2 rupees. It's basically what I expect tomorrow minus where it might go down to, the worst place where it might go down to. So it kind of takes care of the time value of money. This formula actually takes care of time value of money. Whereas this guy, 100 rupees, it stays as 100 rupees. What you said, W0 remains at W0, and this is the worst loss that can happen. The worst value that it can get. So it is 98, it can become. So the worst loss is 100 minus 98, 2 rupees. But actually, by tomorrow, I expect this 100 to become 106. That's the point of this W0 into 1 plus R bar. If it's
Yes,
giving
yes.
me in a everyday 0.003 actually 0.3% returns, then I would expect it not to remain at 100 but become 100.3 or something like that. So this would become, that would be the extent of loss that I'm. Okay, so
Okay, ma'am.
we will
Okay.
typically go for the relative value at risk, although you should also know that this is the absolute, and why we are going for relative is this also. Okay,
Sure.
so
Yes.
so I think the arithmetic is clear. So typically we will calculate, because Z star is mostly will be negative. So this negative value and this negative value will become a positive loss, because we are defining it as a loss. So this will become a positive number. So that much of loss is what can be the worst loss in our holdings. Okay, so uh, so if we were looking at it from a absolute perspective, we are expecting that on this asset with 95% confidence, we can say that we can maximum lose 18,392 rupees. But if we look at it from a relative VAR, then we will say it will be much higher, isn't it? What will be the value? It will be basically 1.645 into 0.04 into this W0. Give me the relative VAR. Relative VAR will be W0 into Z into sigma. Because we want this distance. This distance is Z sigma. From the mean, this distance is Z sigma. So somebody can pick
19,210.
19,210. So that is the relative value at risk. That is the maximum we can lose. Okay. So are we getting some hang of the idea of value at risk now?
Yes.
Yes, ma'am.
Okay, so that will be the value at risk. Therefore these are the steps. If I can go back, so first you have to market your current exposure, how many assets at what price, that will be your W0. Set the time horizon, in this case 1 day. Get sigma of this underlying, if you are saying returns, then get the mean and sigma, actually get mu and sigma. Then you have to assume a distribution. We assumed a normal distribution, but you can also do, if you have a software, then you can also do students t distribution and all that. We will do this through Python. Then you have to set a confidence level, and once you have the confidence level, you can report the worst loss depending on whether you want the absolute or the relative. Okay, so this is the worst loss that can happen. Now up till now we have been doing a 1 day loss. Okay, one thing that you must remember, and this I tell all the time, is that, where is my Excel? See, all this we found out with respect to arithmetic return. If you use logarithmic return, you will get a little different values. All right. In fact, if you use a subset, I have taken, I think, 3 years data, 746 data points, 3 years data. If you take 5 years data, you will get a different mean and standard deviation. If you take 2 years data, you will get a different mean and standard deviation. So all these are parts of the model that you decide. So these are what we call statistically point estimates. You can also get interval estimates, but we will not get into interval estimates right now. This is just a point estimate of the value at risk. And you can also have interval estimates on that estimate, on this VAR. All right, because see, this is just a statistical value which depends entirely on the sample that you have taken, the way of returns you have calculated and all that. So do not think that these numbers are etched in gold. Okay, this is a very very great number. So sometimes I find, students giving up till 4 5 decimal points answer. It doesn't make any sense, because even this is not a very precise number. 18,392 is not a precise number. It's just this calculation gives me this, but it's somewhere near. Okay. Or 19,210 is somewhere near. If you use the logarithmic returns in your for your modeling, then you will get a different value. If you take 2 years data, you will get a different value. If you take 10 years data, you will get a different value. Is this understood? So you don't have to become too precise when you do all this. We can be a little bit less imprecise, because there is a lot of measurement error. We call all this, in statistics we will always have to be aware that we are making measurement errors here. Nobody knows the true return, true mean, true standard deviation are not known. These are all samples that you have taken, and you will make measurement errors. So with that, okay, one thing that I would like to also tell you is, this is assuming a normal distribution. Suppose I do not assume any normal distribution. Okay. Suppose I have this is my data, these are my returns, and I want to have the 95% confidence level as using that same not really discrete, but not assuming any distribution, that is using the empirical distribution, what we call as the empirical distribution. What would we do there? We would sort this entirely. So I have 744 data points here. I would sort it say from column H, from smallest to largest. Okay, so this is what I would sort it. Now what is my number of data points? Number of data points is, I think, 746 744. I want 95% value at risk. Okay, now if I want 95% value at risk, that means I want that cutoff such that 5% of the data are less. So let us look at 5% of this value. 5% of this value is equal to 5% into 744, 37.2. But we do not have, so we want the 37.2th number. We want the 37.2th value, because you see these are the entire values. What do we want? We want that value of return such that 95% of the data is greater than that, and only 5% of the times returns can be, losses can be lesser than that, isn't it? That is my definition of value at risk. So I want to go till 37.2. Let us go to 37.2. 37.2 is here. So this is 38. So this is the 38th value, and this is the 37th value. Fine. What does it mean? 95% of the time, that is 706 times, returns are greater than these values, right? 95. So I have to give a value which is at the 37.2th. Now, some people say that do some kind of interpolation and all that. I don't even want you to do the interpolation. Take the 37th value. So that is, you round this down. If it's 37.2, even if it is 37.5, take the 37th value. Okay, so from the 37th value from the lowest part, go to the 37th value from the lowest part. This return will be will be worse, actual returns can be worse than this value only 5% of the time, and returns will be better than this value more than 95% of the time. Do you agree? Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay, so then this will be my R star. Here when I take R star, I do not assume any distribution. It's something like that discrete case. So if I don't assume, then this is 0.0515. So here my R star was minus 0.063. But if I take it in a from a empirical point of view, which is basically called non-parametric, I'm not assuming any distribution. I'm just taking an empirical data. Then I will look at the 37th value and my R star will be 0.05. Some other, never mind all that, 0.0515. Uh, 0.0515 is my R star. Okay, and that is negative. Sorry. And that is negative. Fine. 0.0515 is my R star and that is negative. Earlier, when I assumed normal distribution, my R star came out to minus 0.063. When I am assuming an empirical distribution, the R star is coming up to 0.0515. And again, you can do the same thing. What is the worst loss? In absolute terms and in relative terms. Okay, so relative terms, you will have W0 into R1 plus R bar minus this W star is W0 into 1 plus R star. R star is now different. Can you do this on your own, or do I have to do it? Anybody wants me to do it, or you can then handle the non-parametric value at risk?
Ma'am, we can do it.
Sure, everybody? Anybody wants me to do this again? Let me know. Otherwise, I'll go ahead because I'm going very slow. I wanted to do a few more things, and because I'm not giving you break, I'll leave you by 9:45, I think. So, so maybe I'll go ahead, and if you can't follow, then tell me, and we will repeat it. So what all did we learn then? If I'll go for parametric, we will assume normal returns, then we can get something. If you think, oh no, it is not following, returns are not following normal distribution, we can go for students t distribution. We'll go for that. Next class maybe we will also go for Pareto distribution and all that. But you can have different distributions, more and more complicated, but we will show that the normal distribution is the best anyway. So with that, we can find out the worst loss. Now what we have found out, so we'll come back to this. We found that the worst loss on a daily basis can be 19,210, because we saw this is W0 R star. Now there is something, so we said that the with 95% confidence, we can say that losses will not be losses. Okay, now daily loss. What am I doing? Daily loss will be less than rupees 19,210. Something like that, I think we got 19,210. So that is what we can say. But suppose suddenly somebody tells you that now you've tell me also what will be the monthly loss, or the annual loss, or the weekly loss. So this is, we will lose, we can lose. But what will we lose annually if somebody asks you, or monthly or weekly? Then what will you do? So there is something called the time aggregation of returns. What does this tell us? Okay, so this daily returns that we calculated is a random variable. R is a random variable which is a daily return. Okay, from here we want to get R, say annual, or say weekly, or say monthly, whatever, say R annual. That annual return is also a random variable, but we can say that it is made up of summation of daily returns. And when we write it this way, we make two assumptions. Okay, so if we say that annual returns can be written like this, we make two assumptions. One is that markets are efficient. No, first of all, okay. So if we can write this just in terms of random variables, that is, this is a random variable which is a summation of these daily return kind of a random variable, where we are summing up from I is equal to 1 to maybe 252 or whatever. So if we are doing this, then the mean of this R annual, so mean expected value of R annual can be written as summation of the expected values of Ri. I is equal to 1 to 252. Basically, expectation will be outside, but then because these are just summations, you can take the expectation inside. This is fine.
Yes, ma'am.
Yes, ma'am.
Okay. And what will be the variance of this R annual? This variance can also, so we will basically write variance of summation E. All right. Now, so if we just have two random variables, variance of x1 plus x2, we can, what is the formula? Somebody will tell me.
Vx1 plus Vx2.
Plus twice
Covariance of x1 and x2.
Covariance x1, x2.
Very good. Okay. Now we can write, so here my assumptions come in, not earlier. Now we can ignore this only when we make two assumptions. So we can say this covariance is 0 only when we make two assumptions. One is that the markets are efficient. What is a efficient market? I don't think you would have studied it in corporate finance. It means that prices follow a random walk. This is a mark of property, and which implies that returns are uncorrelated. Over successive time intervals. Okay, so when we say we make this assumption that markets are as efficient, prices follow random walk, that implies that returns are uncorrelated over successive time intervals, then this covariance becomes 0. All right, so with that assumption, we can make covariance equal to 0, and then we can write variance of R annual is equal to summation of variance of Ri. So is that fine?
Yes.
Then it becomes only variance of R1 plus variance of R2 plus variance of R3 plus variance of R252. So then it becomes variance of R annual becomes summation of variance of Ri. Or in other words, standard deviation. So, okay, so this much we can do. Another assumption we need is that all individual returns on an every day follow the same distribution. That is, returns are identically distributed. Okay, so if returns are identically distributed, each of these expected values of R1, R2, R3 all are the same mean, and variance of R1, R2, R3 all have the same variance. Right? So when we make, is that clear?
Yes, ma'am.
So basically what we are saying is Ri follow the same distribution, having the same mean mu. Here I'm not intentionally not writing any distribution. So it could be standard students T or whatever, but the same mean and same standard deviation or the same variance. In that case, what we will have is this will be equal to so if we can write this as say T mu, and this will be as T sigma square. Okay, let me write it in the next page, otherwise it's becoming cluttered. So if I can assume that returns are identically and independently distributed. The independently distributed comes from the random walk theory, and identically distributed is an assumption we are making. So if we can assume that returns are IIDs, then you can aggregate. So even if you have taken daily returns, but you want a annualized returns kind of a thing, then what we will have is, and suppose you know returns are IID following some distribution with mu and sigma or sigma square, any distribution, it can be a any distribution, then you can have that. So let me call this daily returns for then we can say annual returns follow this distribution, and here the normal distribution is very suitable. Of course for students T also this is valid. So this will be T into mu, that mean will become T into mu, where T is the number of days in annually, T mu and T sigma square, or in other words the sigma would be sigma root T. Okay, so earlier if we have found that the sigma is 0. So if we have found that annual daily returns follow normal distribution with mean 0.004 and standard deviation 0.03, I guess I forgot, or the other way around, 3 and 4. Then we will say that the annual returns follow a normal distribution, assuming 252 days in a year. We will say that the normal returns follow a mean of 0.003 into 252 and a sigma of 0.04 into root over 252. Is this clear? Because the variance will be into 252, but sigma would be root over 252. Fine? And then you can find out these things. So then you can find out the annual value at risk. Is this understood? No feedback.
Yes,
Please.
Yes, ma'am. Yes.
Okay, okay. Anybody has any doubt, do let me know. Okay. So even if we have daily returns, but from there we want to go to say weekly value at risk or monthly value at risk or annual value at risk, we just have to convert the distribution. Now when we assume normal distribution, this conversion is very easy. It's not that easy for other distributions. For students t also it's like that, but for other distributions it's not that easy. Hence we will mostly work with normal distributions. Anyway, so this is basically all about time aggregation. We will also come to correlated returns next class, but we will stop here. And if you have any queries, you can ask, otherwise you can leave the class.